Welcome to the monthly 3Edge View from the Edge for June 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. Today, as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary research model. We'll also take a closer look at India in light of the recent elections there, and we'll have a special guest for that segment as the president of our firm, Chandra, will join us to provide a closer look at the recent elections in India and the potential implications for the Indian economy and just the long-term outlook for India, which recently surpassed China as the world's most populous country. In the markets, after a difficult month of April, May was a strong month for U.S. equities. Three major indices all advanced. Ex-U.S. equities were also generally positive in May. Now, as we turn into June, investors seem more encouraged by recent economic data, which may indicate a gradual softening of the labor market and a potential commensurate softening of the U.S. economy, which could help bring down inflation towards the Fed's 2% target, thereby enabling the Fed to finally begin to lower short-term interest rates. Recent data showing the potential for a gradual slowdown has sparked a rally in bonds, with yields continuing to decline here in early June. And lastly, this past week, the European Central Bank actually moved before the Fed and cut interest rates by a quarter point for the first time in 5 years, as inflation has continued to ease in the Eurozone this year. So let me bring Eric into the conversation now and provide our outlook for the global markets based on our research model. And let's begin by reviewing the 3Edge asset class matrix, which shows our outlook for the major asset classes and what may have changed since last month. So Eric, over to you.
Great, thanks, Fritz. We can see here on the asset class matrix, not a lot of movement. You're still finding U.S., developed Asia, and Indian equities in that positive one spot, so still attractive there, and our clients have exposures to that. A more mixed outlook with Europe, and still a bit negative there on broader emerging markets and specifically China. The notable move up is commodities there at the bottom, joining gold in that plus one spot. So I'm sure we'll talk about these asset classes a little bit more.
Yes, we will. So let's dig into the major asset classes in detail, and we'll begin with equities. And why don't we begin by looking at the U.S. equity market?
Sure, yeah. U.S. equities had a strong month of performance in May, up over 5%. Investors became more hopeful that the Fed would be able to begin to lower short-term interest rates at least once and maybe even twice in 2024. So whilst U.S. equities are still significantly overvalued by the way in which we measure, behavioral factors continue to support the prospect of this rally continuing, at least in the short term.
Excellent. All right. And now let's go ex-U.S. and begin with Europe. As we mentioned, they have cut interest rates here this past week. What is the model indicating for European equities at this point?
Like in the U.S., European equities also had a strong May, up around just over 5%. The European Central Bank, the ECB, did announce that highly anticipated decision on monetary policy to lower that short-term interest rate, despite the inflation report showing the first increase in inflation in the Eurozone region in 2024. That said, it was a very small increase in CPI, and the overall level of inflation is well behaved in between 2 to 3%, down from over 10 back in late 2022. So all that said, taken together, the shorter term outlook remains a bit concerning with the inverted yield curve measures that we calculate for the region. Should the ECB continue to lower rates, this may help to re-steepen that yield curve in the months ahead, and that could be indicative of the potential for future growth. We're just not there yet. So more to come.
All right, good. All right, so let's shift our attention to Asia and take a look at Japanese equities.
Yeah, while Japanese equities had a more modest 2.5% rise in May compared to the U.S. and Europe, the overall model outlook is favorable. With you're seeing positive contributions from investor behavior, tightening credit spreads, steepening yield curve measures. Regarding the yen, we are seeing the potentially limited downside for the Japanese yen due to the Bank of Japan's interventions, and this includes actual direct currency interventions near that 160 yen to the dollar level, as well as the potential for monetary policy interest rate increases at the short end. So our research favors an unhedged Japanese equity exposure. And it's worth noting here the divergent global monetary policies that are taking root. You have this ECB lowering, you have the US Federal Reserve holding steady, and the BOJ increasing. So this should hopefully provide opportunities in the months ahead.
Absolutely. All right, let's shift our attention to the emerging markets in China. And what is our model outlook there?
Yeah, Chinese equities in May alone were up over 13% before settling up just under 5% for the month. So a bit of volatility there. Broader emerging market equities generally rose along with this, though to a more muted extent, finishing the month up about 2%. Exports and imports are both picking up steam in China, which may suggest this potential rebound could be underway. And this may help offset a lot of the negative forces that remain in China from the weak domestic consumer spending, really probably driven from the stagnant Chinese real estate property sector. So the outlooks may be improving, but still overall negative in the near term.
Okay, and so now we'll look at our last equity asset class that we'll discuss here today, and that is India. And as I mentioned earlier, I'm pleased to bring into the conversation the president of 3Edge Asset Management, Monica Chandra, to get her insight into the results of the election in India, which did not exactly turn out as anticipated for Prime Minister Modi. So Monica, welcome to The View from the Edge. And I think it would be actually very interesting if you could just describe the sheer magnitude of the task of conducting a nationwide election in a country as large as India.
Thanks, Fritz. It's great to be here, and it's been quite a week. So as we know, India is the world's largest democracy, and it has a population of over 1.4 billion with a B. The 2024 elections, which just concluded, were colossal, colorful, and complex. So let's start by looking at this slide, which shows the registered voter population at a staggering 969 million. It's the largest electorate in the world. And you can see how this compares to other large voting countries. It is important to remember that the size of India's electorate is more than the population of all the countries in Europe combined. And as you can imagine, that creates some challenges. So let's look at the next slide. The Election Commission of India is the country's independent poll conducting body, and they are the ones who carry out this process. Elections in India are always multi-phased, given factors like infrastructure challenges, security concerns, attempts at rigging, and they involve the deployment of significant federal security forces. So this time around, the elections were conducted in 7 phases. It was the largest in terms of time period. They started on April 19th. They concluded on June 1st. And the results were all tallied on one day, and they were declared earlier this week on June 4th. So it involved 1 million polling stations. The voter turnout was around 640 million, which is nearly 66% of the voting population. And by all measures, this process was smooth and peaceful, which is just remarkable.
Really is. So now let's get into the results of the election, since they were somewhat of a surprise. What happened there?
Yeah. India is a multi-party democracy, but it really has 2 principal national parties, Prime Minister Modi's BJP and the main opposition Congress Party. And then they work with several local parties to form coalitions. In 2019, the BJP secured a landslide victory, and they were able to form the government on their own because they had a majority, which is essentially the requirement to have 272 seats out of the 543 in the lower house of India's parliament. And as in everything, setting expectations is important. And this time around, Mr. Modi had a very bold claim of winning 400 seats out of the 543, along with his coalition partners. So while by all measures they won, Modi's coalition won 293 seats, enough to form the government, it is a victory that feels more like a defeat, given the goal that they had set for themselves of 400 seats. And an early analysis of the results shows that there are a few key areas that led to this. So let's look at the first one. It was basically discontent among rural poor. So while larger cities in India have seen an economic boom recently, millions of rural voters, particularly farmers in the largest food-producing belts, have been protesting to demand better crop prices, debt relief, and pensions. They turned away from the ruling government in key states. Next, Secular issues seem to have played a role. While India is a secular country, the BJP has long been identified as a Hindu party. And that chant reached fever pitch earlier this year with the resurrection of an ancient temple, which seems to have further distanced some communities, particularly Muslims. Muslims are a very large part of India's population. Over 200 million Muslims live in the country. And frankly, others who believe that religion should not play a role in politics also seem to have been disenchanted by this message. And lastly, unemployment, particularly among youth, falling income, inflation, these were some key areas of worries for voters. And they seem to be unhappy with the ruling party's progress in job creation. And that seems to be the third key area why BJP did not gain as many seats as they hoped to.
All right. All right. So now let's take a step back, and maybe you could provide your longer term outlook for India as a country writ large. What do you see?
So firstly, I'd say stability is an important factor for any country, and particularly for the markets. And there's no doubt that Mr. Modi is returning to power for a third term. That's a solid mandate that he has. Next, I'll say structural factors in India and its position as a global player remain solid. While there is a long road ahead, India has seen dramatic improvement in the past decade in its physical, digital, and regulatory infrastructure, and we will continue to see great progress here. Geopolitical factors are forcing developed nations to diversify their manufacturing footprint. India has emerged as a strong player in that battle. Demographics are on India's side. It has a very young population. The demand for goods and services internally is large. So the growth outlook in India should continue to be strong. So while we did see a blip in the market earlier this week, it seemed to have been a one-day result just based on the shock of the BJP not gaining as many seats. But I think things will stabilize. Mr. Modi will be sworn in for his third term on June 9th. And I think things should return back to normal, and we should continue to see a strong outlook for India as we look ahead.
Thank you. Monica, great. Thank you very much for your insight. Very helpful, very comprehensive. And so now I'm going to go back to Eric and see what our model research is indicating for the India equity markets.
Yeah, no doubt the results of the election in India were disappointing for Modi and the BJP party. That said, as discussed, the BJP did win enough seats to form that coalition government. And so except for a one-day post-election hiccup that we saw in the markets, India's equity markets are benefiting from positive investor psychology, market momentum in 2024. While only up a little bit over 1% in May compared to the other equities that we discussed, they are up over 8% on the year through the end of May. And the Reserve Bank of India, India's central bank, may lower short-term interest rates in the near term, with inflation measures in the region back in their target range, which could provide a further boost to the near-term outlook.
All right. So let's shift our attention now and look at the bond market and the current interest rate environment, starting with the U.S. Treasury market. What's our model showing us there?
Yeah, the U.S. Treasury markets definitely have struggled here in 2024. Those intermediate duration treasuries, like an index of 7 to 10-year treasuries, was down over 4% on the year through the end of April. But in May, we saw bond yields decline and bond prices rise, which move inversely, in response to reports indicating the softening in the U.S. economy and labor markets, which could help bring inflation down closer to the Fed's 2% target. So this closed the performance gap with the same index, that 7 to 10-year Treasury index, down only 1% on the year through the end of May. All that said, we find shorter maturities continue to provide more attractive yield without the interest rate risk that you find in those longer-term maturity treasuries.
Got it. All right. And what about corporate bonds? What is often referred to as the credit markets? What are we seeing there?
No change to this outlook. The inversion of the U.S. yield curve continues to signal the risk of a potential economic slowdown, and that is just not reflected in corporate credit spreads where they are. They're very tight levels historically. So the outlook remains cautious in the credit markets for us.
All right, great. So now let's look at asset classes that refer to as hard assets. This would include for us gold and commodities. And why don't we begin with our outlook for gold?
Yeah, gold's had a strong year so far, up in 2024, almost 13% in the year through the end of May. and continuing to rise here in June. It's benefited from positive investor psychology measures, momentum measures, an increase in global central bank purchases, rising political tensions has people clamoring for gold, and we've seen some short covering, which could also be a boost. And this has all happened in the face of generally rising real, that is inflation-adjusted, interest rates in 2024. They're now around 2% positive. Typically, real rates and gold move inversely, so that it's been interesting to watch the gold climb while these rates climb. Should we see a decline in real rates, this could just help further support continued gains in the price of gold. So the outlook remains favorable.
Excellent. All right. What about commodities? What is our research telling us there?
Yeah, based on the research, the general outlook for commodities has improved. That was the one notable move we saw in the asset class matrix, with investor sentiment in China potentially moving to a more positive footing. You're seeing continued global geopolitical conflicts and the rising price of gold we just talked about. Collectively, that all bodes well for a broader commodities outlook. We've seen a number of commodities touch all-time highs as well, due at least in some cases to supply shortages. And so then in addition to all that, you have this potential for the value of the US dollar to decline, perhaps as the Fed prepares to lower rates. And so dollar-denominated assets such as commodities may benefit from that as well.
All right, terrific. Eric, thank you. Thank you for providing our monthly view from the edge for June. And thank you to our special guest today, President of 3Edge Asset Management, Chandra, for her insights into the recent election in India. And just to summarize our discussions here today, at least for the time being, our research indicates that we continue to be in a favorable environment for both equities and hard assets, and we remain in a period of later stage economic growth. So that will do it for me and Eric here from the 3Edge View from the Edge. We will be back again in early July with another edition of the View from the Edge. If you'd like a hard copy of our full View from the Edge newsletter for this month, you will find that on our website, and that's at 3edgeam.com. Meanwhile, Steve Cucchiaro and I will be back next week with the latest edition of the 3Edge Weekend Review. As a reminder, our entire library of video content is always available on our 3Edge YouTube channel, and if you think someone you know may benefit from these videos, please feel free to share them. So on behalf of Eric, Monica, and everyone here at 3Edge, thanks for listening.